Greetings, Jonathan Camarda. Hopefully you folks all enjoyed the Super Bowl. Little light note, when the NFC team wins, that would have been the Eagles last night. Sorry to Philadelphia fans, but the market historically has been up low double digits that year. And when the AFC team wins, that would be the Chiefs. The market's up high single digits that year. Although that was basically flipped over the last 20 years, thanks mostly to the New England Patriots, which the market did very well during their reign and their dynasty. So with all that being said, that's just all, fluff. Anyone who actually looks at that data or speaks of it with any real relevance deserves a pay cut and maybe a pink slip, dare I say. So now on to the real news of last week. So really right down to it, levity aside. So as we moved to last week, we heard a few voices there. The Fed sounded pretty accommodative. Again, no pivot in sight. So markets that are waiting for an extreme pivot, not going to happen. Inflation is persistent. However, they did mention disinflation, and Jerome has actually acknowledged some pockets of weakness in the economy, which of course the market liked that very much, unlike last year's tone pretty much throughout. Now, on the top level, we all talk about inflation being persistent, but a few global macro points. And none of these are political, by the way, so just an asterisk. We never mix politics investments. So however you feel about politics, et cetera, they should never, and I do mean never with a capital N, influence your investment decisions, as most folks lose money that way when they do so. So with that caveat aside, these are just some global macro facts that are causing inflation to be pretty persistent. So with an inward bias towards production, as this country has been for the last few years, that's generally inflationary by its nature. And economic theory of comparative advantage, which in English means when country A can make a product with a good efficiency, but country B can make it with an excellent efficiency, it pays for them to trade, at least for country A, to then buy said product from country B, right? So when you're doing it all yourself, even though you do it okay, it's not the most efficient, which means it's more expensive than it should be, which means it's inflationary, okay? So that's just a generality, but that is causing inflation to be pretty persistent. The next thing is when you have a bottomless pocketbook, like we seem to have in helping allies out, no matter how noble the cause may seem to some or not to others, doesn't matter. In this case, it's the Ukraine situation. We have a bottomless budget, with just commas and zeros spending, that causes an inflationary pressure. We also have, again, on an energy standpoint, Russia's running into some issues. India can only buy so much oil from them. So they're running into how much they're going to be able to supply. And you see energy prices starting to go up again. That's inflationary. Okay, so there's some dynamics there. On good news last week, again, there is an inflationary note, but I'll start with the silver lining. Insulin costs came down. So that's actually pretty nice to hear from many. I think it's 1 in 5 folks out there suffer from diabetes, even that don't even know about it. So definitely get checked out if you think you may have some of the symptoms there. Now, the healthcare industry in general, we all know, has always been chasing symptoms, and sometimes the cure is just elusive, just my own editorial on that. But sugar, going to the back end of the diabetes point there, has quadrupled the price of sugar, which we mentioned since 2020, a couple of podcasts ago, that has quadrupled. That is very inflationary as well. In fact, shortage of sugar, I didn't know this, is one of the leading causes of unrest. Again, I don't know how that trickles down to the actual products that it's in, et cetera, but interesting. All right, so another note as well, that we look, again, the geopolitical tensions, again, and we talk about trade and efficiencies. Those are being tested, as we know, without getting into details. And so those are all, again, inflationary just in general. So beyond just the wonkiness of interest rates and yield curves, just thought I'd give you from a global macro standpoint the persistency of inflation and what the Fed's going up against. Now, a couple of things I didn't hear last week from those. We talked about infrastructure. I think U.S. is 13th internationally and as such, and strong job growth and a tight labor market, which on the surface it would appear. However, there are cracks in that facade, okay? We've already mentioned this, so I won't go into a diatribe, but tech companies and financial companies are laying off thousands of workers. That is a leading indicator. Some say, well, they were just hired in 2020. Doesn't matter. That is a leading indicator of a slowdown, which the Fed is getting, actually, and they showed that they got it last week, which was impressive. The other thing is that we really heard very little of AI. You hear about these AI chats and how it's affecting university students and on their exams using AI, but we didn't really hear how it's affecting the economy because the jobs that are being cut, the technological advances, 3D printers that create materials to build houses, we really didn't hear about how the country is adjusting to that. Really just talking about hard, industrial and infrastructure jobs. So the one note is it sounds like we're a few decades old in how we're looking through from that lens. Again, somewhat of an editorial on that, but there's a lot of fact in there. You guys can look that up and gals and see what I'm talking about. Very little forward looking on how AI is affecting the economy and such and some of the inflationary pressures there. Now, to what you all want to know about the market. So a couple points on the market. Boohoo, we had the 5-week winning streak come to an end. Small caps and NASDAQ, which led the way up, down 3% and 2% respectively, with the S&P down about 1%. And the market needed a breather. Generally the back half of February is challenging, so a little volatility here and a little bit of chop is not to be unexpected. As we look at markets, though, technically, in the intermediate time frames over the last several months have broken downtrends. However, on the longer term, 2-year perspectives, there is still some headwinds to the upside. So what does this mean? Well, it means that you really just don't know. So the one thing in money management where we try to show folks, and we see so little of this out there when we're looking at folks that come in to engage us, is that, again, you cannot control the performance that you get. Right? You can't go into a year saying, I'm going to make 20%, I'm going to make 10%. That's like walking out of your house and saying, it's sunny out, I'm wearing sunglasses, and it's a torrential downpour. You can only control what you wear, or in this case, your risk management. What risk exposure are you willing to take based upon the environment and the ever-changing landscape? And that's all you can do. And that's how the smart money manages their money. So that brings me to my point of where the market is now. It's kind of at a juxtaposition. So we don't listen to the doom and gloomers on TV, every one of them that are betting against a market or a certain stock. And then we're also not Pollyanna that this is the end of the bear market and a bull is going to come to the upside. No, these are shades of gray, as we mentioned. We can only control our risk exposure. So we shall see as we're at a critical juncture. I have no projections except to promise that we will adjust accordingly based upon what the terrain brings us. Now, that brings another note that we have, so I figured I'd mention it as a lot of the personal wealth advisors are engaged with clients over this, is the amount of cash, or in this case, the fund is called SNOX with 2 X's, Fort SNOX, Federal Reserve Overnight Treasury Obligation Fund. That's paying right now. It does vacillate, but about 4%. That is an intended allocation based upon a paint-by-number systematic strategy decisions. So this isn't money that just gets thrown into that fund and it's forgotten. Are you going to invest it? Did you invest it? Everything is strategically planned out. There are no lapses in time frames of, that money's there. It's strategy based. Now, for clients, for example, that are more aggressive, and depending on their time frames, conversations with your PWA should occur to see, again, if you want more risk appetite injected into your overall investment position statement. That's a separate conversation, though, on the strategy-based decisions of allocating, in this case, to these Federal Reserve Overnight Treasury Obligation Funds. So I thought I would just get that out there, as they're great questions, but no, that money is not there. Just because it got left there. Like at large brokerage firms and such, you say, well, my broker left money in cash for a few years. That's not being the case. Every rock is overturned and every little squiggly thing underneath it is accounted for with extreme, right down to the decimal point precision. Then we look at the investment, position statement of the client, and certainly we can adjust the volume knob, so to speak, on how allocated clients want to be to risk assets. Back to my point of risk exposure. That's what we can control. But when it's winter in Alaska and you're in a bathing suit, I think they call that the Polar Bear Club, they know what they're getting themselves in for. Same thing we convey to you as clients. Depending on the environment, we can only adjust how we're going to prepare for that. We cannot control the climate. We cannot control the markets. So thus, saying how much you're going to earn over the next year is much like saying, well, it's going to be sunny the next 10 days. It just is. And that's what I'm projecting. It's the same theory. Can't control either one. So off of that editorial note, I think it's very important sometimes to inject that just because we do tend to look at things from a satellite global view and from a client standpoint, hey, if I'm in your seat as well, that's what I'm looking at. I'm like, hey, what did I earn? What did I make? But understand that the smart money, it's always the tip of the iceberg is what clients see as the returns, but they don't see what is underneath the water level, and that's the risk. Just ask those on the Titanic. think that's coming out. Are they re-releasing that into the movie theaters? The same movie, I heard. I haven't heard of that. And especially with the advent of technology, I guess there's enough romantics out there. They've done their questionnaires that enough people are going to go to the theater to actually watch the same movie over again. I don't know if it'll be in 5D, etc. With that being said, on that moment of levity, we appreciate your time, your patience, and your trust. Until next time, this is Jonathan Camarda. Stay frosty.